Hello everyone, my name is Jane Gray and I'm the head of Covenant Review here in Europe. Welcome to our quick 30-minute update, Q2 2025 from Covenant Review. Today I'm joined by Shoshanna Harrow, and she is a senior director here at Fitch, and she's also one of our high yield lawyers. Firstly, I wanted to apologize very quickly for this delay. We had a little technical issue with the slides, but they're fully uploaded and hopefully you can see them. I also wanted to mention before we get started that on the left-hand side of your screen, you should see our new e-learning series, Covenant Fundamentals, Building Knowledge and Understanding the Basics. I do hope you can hear me. I can see a attendee questions saying you only hear music. Please let me know in the chat if you can now hear me. As I was saying, we have a new e-learning series. It's 11 modules. It's really about learning at your own pace, everything from the covenant system through to European intercreditors agreements and also European LMEs. You'll also see at the bottom of your screen some really fun emoji features. Please feel free to react to any of the covenant terms that we'll be talking about over the next 30 minutes. And with that, let's just launch straight in because I realize we're running a few minutes late. I'll pass over to Shoshanna for the bond side of things first.
Thanks, Jane, and hello, everyone. Thanks for joining us. It's been kind of a wild ride this quarter for European high yield, as I'm sure you all know. If we look back at the first month of the quarter, primary was essentially non-existent for much of April, other than a handful of refinancing deals as the market kind of reacted to tariff and trade war concerns. Things then picked up to a nice brisk pace in May, and we started to see some new paper alongside the usual raft of refis. And then along came June with this record-setting supply. I think probably all of you on the call have been sleepless for a month now, as have we. There's just been this rush of bonds with plenty of new money deals. And of course, by the end of the quarter, according to our colleagues at FinInsights, Q2 volume was 41.96 billion, which surpassed the prior record of 41.3 billion set back in 2021. And it took the volume for the first half of the year up to 61.94 billion, which is more than what was issued in all of 2016, 2018, 2022, or 2023. So it's been quite the month. Now, in terms of what covenants have looked like over this pretty crazy quarter, if you go back to April, you might have thought that given that there was no supply, covenants might need to be tightened a bit in order to start getting deals done. And then at the other end of the quarter, it would have been reasonable to think that because there was this almost endless supply to choose from, maybe you'd see more conservative covenants offered up to entice investors towards a particular deal. But in fact, that's really not the way it went. And as we'll see in details over the next couple of slides, covenants have generally stayed loose or gotten looser, particularly for sponsor-backed credits, with the needle definitely moving more towards issuer-friendly than investor-friendly. Terms have been permissive overall, and although we and our colleagues at FinInsights continue to hear from the buy side that covenants are a concern and a focus, when books remain oversubscribed, there's just not often much success in pushing back on flexibilities. So we'll take a look now at some of the detail and get into the specifics of what I mean by permissive. And Nancy, if you could show slide 1, please. We'll take a look at day 1 capacity across 3 metrics that we regularly measure each quarter, which is capacity for debt, capacity for dividends and equity purchases, and capacity for unrestricted subsidiary investments. And I'm just going to pause here and ask if you could let us know in the chat if you're able to see that slide, because I can't from my end. Not sure if you can. If not, I'll just try to talk you through it. But hopefully you can see on the chart here that the average for the quarter in terms of debt capacity was 1.8 times opening EBITDA. Investments in unrestricted subsidiaries stood at 1.3 times opening EBITDA, and then there was on average just over half a turn of capacity to send money up to shareholders. So right out of the gate, without even touching a ratio carve-out, and those, by the way, usually give an issuer plenty of headroom, there was an awful lot of capacity for dilutive and or priming debt, and an awful lot of capacity for value leakage. In terms of quarter-on-quarter change, we didn't actually see a lot of movement Q1 to Q2 on these latter 2 metrics, but there was actually a big jump on the debt side from Q1 to Q2. And Nancy, if you could move then to the next slide, please. On this one, you'll see the breakdown of sponsor versus non-sponsor capacity. And, you know, not surprisingly, the sponsor covenant packages have been more flexible. Debt and unrestricted subsidiary investments capacity day one has been 2 times and 1.4 times opening EBITDA, respectively, versus just under half a turn of capacity for those metrics on average for non-sponsor deals. We'll move now to the next slide and just take a quick look at EBITDA add backs. You'll see that there's remained plenty of scope for add backs in most sponsor deals. Just over 60% of them allow uncapped savings and synergies to be added back to EBITDA versus a more modest third or so of non-sponsor deals, which allow them on an uncapped basis. And for the deals that have a look-forward period, and I'll note that not all of them do, that look-forward period is getting steadily longer in sponsor deals, with the Q2 average being 25.8 months. There was some better news on the non-sponsor front this quarter with a much lower average of 15 months. We'll move on now, please, Nancy, to slide 4, where we can see pick your poison baskets, which really jumped this quarter, had quite a dramatic rise. And that's definitely contributed to the really enormous average day one debt capacity that I mentioned earlier. We saw pick your poison provisions in just about 60% of sponsored deals this quarter. And while they weren't as common in non-sponsored deals, there was still an uptick, as you can hopefully see on your screen here. Moving now to the next slide, that touches on available amount baskets, which also jumped quite a lot this quarter to 16% of deals. And I realize that 16% doesn't sound overly dramatic, but it's really a trend that's heading in the wrong direction from a covenant standpoint. Just as a reminder, available amount baskets are provisions that have jumped over into bonds from loans. They started a couple of years ago, and they give an issuer a second cumulative basket in the restricted payments covenant. So on top of that traditional net income-based basket, they now have a basket that starts with cash flow and builds from a lot of other things. Now, but what started as a trickle in bonds in terms of being seen in a handful of deals has now become quite a flowing stream, right? And we're seeing available amount baskets in bonds more frequently. And of course, each time it clears in one deal, it becomes easier to hold up as precedent in the next deal. And before you know it, it gets pretty pervasive. And we'll move on then to the next slide, please, Nancy, and give you a great example of how that's happened before with the quarterly zero floor. Now, so this is something that was initially an outlier in bond deals, but has now really taken hold. So as a reminder, with a quarterly floor in the restricted payments build-up basket, there's never any deduction of a deficit in C&I, right? That limb of the build-up basket becomes upward only. Now, this is a far cry from what used to be the norm, where an issuer had to look at the whole build-up period as one big accounting period, and if C&I was negative over that period, they had to deduct the whole amount, so you could go negative in that limb. First came along the quote-unquote normal zero floor, which still looked at that build-up period as a whole and made you deduct negative C&I, but only until you hit zero. And then came these quarterly floors, which basically let you zero out individual quarters, no matter how big the loss in a quarter, but you still get to count all the positive quarters of the build period. And when you run the math on that, it works out very, very much in an issuer's favor. And as you can see in the charts here, today, more than 80% of build-up baskets in European high-yield deals or this quarter had a zero floor. And of the deals with a zero floor, more than half of them were the more aggressive quarterly version for sponsor-backed credits. Quarterly floors also rose sharply for non-sponsor deals. So it seems very much that this formulation is becoming more and more market. Started out as an outlier and is becoming the norm. So we'll move to the next slide now to just talk through a couple of points on value leakage. So this is a bit of an interesting one. We take a look at how many deals set their leverage-based restricted payment threshold test at or above opening leverage. And here we actually saw a downward trend this quarter for sponsored deals and the opposite direction for non-sponsored deals. But before you get too comforted by that, I think if you look at the graph as a whole, you can see that the overall trend is upwards. So more of these sponsored deals are setting the test at or above opening leverage than used to be the case. And also, of course, in your sponsored deals, you're more likely to find the kinds of calculation flexibilities and debt exclusions and EBITDA add-backs that make that test more fiction than fact in any case. So this quarter's downturn isn't really as nice as it seems. Now, the second chart on this slide shows the uptick in deals where disposal proceeds actually build capacity for value leakage in the form of dividends or investments or other types of RPs. That was a feature in exactly half the sponsored deals this quarter, which is a sharp increase from Q1. So we'll move to the next slide, please, and zoom out a little bit now to talk about what we've seen by style of deal. And of course, this quarter, as we have had for many quarters, there's been a steady flow of bonds that are issued to simply replace existing series. And the trend remains the same there for this quarter as it has for the last several quarters. You start with your existing covenants and you turn the dial a little bit to make them even more flexible by doing things like adding or upsizing baskets, loosening your ratio tests, increasing scope for add backs, making your build-up basket easier to access, backdating it to pull forward existing capacity, adding portability. And then in a notable number of deals this year, we've seen them add IPO clause, kind of a spate of that in the last couple of months. And the one general comment I would make on refis is that this past quarter, we've started to see a lot of deals coming to market to refinance bonds that were issued in 2021. Another busy year, very, very borrower-friendly, quite aggressive covenants to begin with. So the starting point has been really permissive, meaning that these types of expansions kind of add insult to a fair bit of injury. We'll move on to the next slide now and talk a little bit about new money deals. And not surprisingly, those have been pretty punchy. Just to highlight a couple of the terms that we've seen over the quarter, I mentioned before that pick your poison baskets have been pretty popular. And what we've seen there are baskets that allow conversion on a 2-to-1 basis rather than the more typical 1-to-1 basis, which again, really, really boosts that day one debt capacity. Multi-use portability has been popular as we see sponsors focusing on their exit flexibility. Build-up baskets have been loose on the whole, with limited conditionality for use, as well as, of course, these quarterly floors that I mentioned before. We also saw in the Skechers cross-border LBO a choice of build metrics for the basket, which is a bit unusual. So it can grow from the greater of 50% of C&I or EBITDA less 1.4 times fixed charges, again with a quarterly floor. On top of that, there was no ratio condition for use of that basket, and they had a quite generous 50% of EBITDA starter amount. Day one capacity that I mentioned before was particularly oversized in some of these new money deals. We saw some set at 3 to 4 times opening EBITDA, and it was nearly 8 times opening EBITDA in the Urbaser deal, which in my view gets this quarter's award for the most egregious terms, with I would say Modular coming kind of a close second. No worse ratio tests really proliferated. They feel like the flavor of the day recently. Used to be the kind of thing you would just see in an acquisition financing and acquired debt carve out, and now it's spread to all ratio tests throughout the covenants. And we find them particularly concerning in the investments context, as they can really facilitate liability management. Moving on, asset sales covenants have been pretty toothless for a long time now, but they've been quite loose over the quarter. We've seen a lot of leverage-based step downs. We've seen broad flexibility to repay other debt ahead of the bond. So, that covenant is becoming less and less protected for holders. I mentioned before this increase in available amount baskets, and I'd say one of the most worrying things we saw over the quarter is that several of them build from permitted debt. So increasing leverage actually increases your value leakage potential, which is kind of absurd. And to come back to Urbaser again, that deal really achieved full circularity because permitted debt builds the available amount basket, and the available amount basket builds debt capacity under the pick your poison basket. So it's like this covenant death spiral that we didn't much like. Their available amount basket also pulled in investments capacity and provided a $200 million starter amount. So it was kind of ugly all around. We saw an interesting universal backdating provision in Modulaire's bonds. So they were new money in the sense that they were issued to repay credit facilities debt, but of course they've got existing bonds outstanding. And what they did was bake in a provision that said we can pull forward all of our unused capacity from the equivalent basket or carve out in our older bonds. And there could be quite a lot of capacity under their older bonds because Modulaire excludes from most of its ratio calculations all of its outstanding carve-out debt. So, they've really potentially rolled forward quite a bit of capacity. And then last but not least, in several new money deals, issuers gave themselves the ability to cherry pick their ratio test with a choice of leverage or coverage ratio test in several provisions. So we'll move on to the next slide now. It probably won't surprise you to know that there was fairly minimal flex in covenant terms over the quarter, given the market conditions. Interestingly, though, this was true even in pre-marketing, which is where we would historically see a lot more movement on covenant terms. We did see some meaningful changes in a couple of deals at the pink stage. We saw limits on structurally senior debt with a new or enhanced non-guarantor cap. We saw baskets get downsized. We saw ratios tightened. We saw new or tighter J.Crew blockers. But flex was on the whole much more muted than it would normally be. There was also some successful pushback in our baser, which included in its parade of covenant horribles, if you will, a new provision that would have allowed it to exclude the negative impacts from tariffs, which was tacked onto an add back that allows adjustments for supply chain disruptions and pandemics and the like. So we wrote a market alert on this. Investors were successful in getting it removed and in getting a J.Crew blocker added to the deal. But unfortunately, there were no changes to the other really aggressive terms, which is too bad. One last thing I want to mention before we move on to loans is a really interesting covenant point that came up in an LME context this quarter in the context of Selecta's latest restructuring. The company launched an exchange offer and consent solicitation in mid-June where the new bonds being offered in exchange for some third out, quite subordinated notes that had been previously issued won't have sacred rights protection for the first 12 months after closing. So your economic and other fundamental terms that would normally need supermajority consent to amend, 90% typically in Europe, can be changed with simple majority consent for the first year. On top of that, there's no anti-layering covenant for the first year, no payments for consent covenant for the first 12 months. The restrictions on liability management transactions covenant is suspended for that same period. So the minority holders, if they exchange into these new notes, are sitting ducks for changes that can be made by the majority. It really creates a prisoner's dilemma for them because they can either stay with their quite subordinated existing notes or they exchange into an instrument where they're very vulnerable. So it's going to be interesting to see how that plays out. With that, I will turn it over to Jane to cover loans.
Thank you, Shoshanna. So, right, if Nancy, could we go to the next slide, please? What I would say is if having the most permissive covenants was competition, then private equity issuing loans would definitely win. Because as you can see, I've taken the same slide as Shoshanna had, her first slide on day one, general purpose basket capacity, and I'm showing the equivalent metrics in loans. And we're going to go through those in a second. Let's just put a bit of color around this. So per LevFin Insights, during the first half of the year, primary volume for all uses of proceeds totaled 152.7 billion euros, and that was from 189 transactions. So it was very, very busy quarter, up from 125.8 billion from 175 deals in equivalent period in 2024. April was a slow pace, but as I'm sure you've all seen, and certainly the leverage loan lawyers at Covenant Review has seen, there was a scrum of issuance in June. Q2 volume as 50.3 billion euros. So there's a lot of volume that happened. Whereas Q1 was overwhelmingly driven by repricings. We had a huge number of repricings. Q2 was much more of a mixed picture, and I think one of the themes that we all saw was dividend recaps as sponsors looked to take out cash for their long-held assets, and that's something we're going to touch on a little bit more when we start talking about portability, of course, and that is, spoiler alert, probably the biggest theme of Q2. But let's quickly go back to these numbers. So day one general purpose basket capacity really is a proxy just for understanding in a very broad sense how permissive the documents are. And as you can see, debt capacity, so this is an incremental general purpose debt capacity, irrespective of leverage, hit an all-time high since we have the data of 2018 of 3.3 times. I mean, that's just enormous. And what the document's really saying is, you borrower can incur as much debt as you would like if somebody in the market is going to give it to you and if you can find the pricing which is palatable. In other words, there is really no tether on the amount of debt that they can incur, and obviously term loans are cov light, so it's going to depend on whether the RCF has been drawn down at all as to whether there's any financial covenant at all. But I digress a little bit. In terms of unrestricted subsidiary investment capacity, you can see that the average for Q2 was 1.96 times. So again, that's an all-time high. And capacity for general restricted payments, that stood again at an all-time high at 0.95 times. So it's an enormous amount of basket capacity we saw through Q2. And the same theme that Shoshanna kind of mentioned is there was actually very limited pushback in this incredibly borrower-friendly market. The sharp increase in debt capacity, same as in bonds, we can attribute that a lot to dividend to debt toggles. The US often call it pick your poison. We call it pick your poison. But actually that cleared in an enormous 39% of deals through the whole of 2025 year to date, and in 45% of Q2 deals. So it really is a provision that seems to be clearing the market more and more. Now let's move on to the next slide. I'm going to talk about this one very quickly. We can't have a covenant review webinar without talking about cost savings and synergies and adjustments to EBITDA. You can see that the norm remained pretty static, that norm being that the majority of deals, 78%, will have a cap on cost savings and synergies. That is what is expected in a European loan. That cap also stayed pretty static. The average is 23.3%. So very normal, not much to see here. What I would say is the devil is always in the detail. And what we saw this Q2 was a narrowing scope of what the cap actually applies to. And that's something that you need to be very, very wary of. And that is something that we saw a bit of flex on. Just a quick reminder without going into too much detail, because I know we're running over. But it's always uncapped. Generally, pro forma adjustments are uncapped in relation to run rate adjustments consistent with or similar to those included in the base case model, any report, any QOV analysis, you'll know that. But what we saw also was any uncapped adjustments commented on or reviewed by any third-party report provider. And that is wide open drafting to allow for future adjustments as long as some third party has given a comment on those adjustments. You can see this hugely loose wording. We saw uncapped add backs in relation to losses for outsourcing. And we also saw caps which were only applicable for adjustments related to majority controlled acquisitions. So again, the devil's in the drafting. Please be aware of that when you're looking at your full form documents. Next slide, please, Nancy. Very quickly, inside maturity baskets, that top of the market again, 74% of European loans allowed for additional facilities up to a certain amount to mature inside our facilities. That's something that we call temporal risk. Again, lost in the plethora of concerning terms that we saw, but it's something to be wary of. They're also in Europe, something that I think, again, often gets overlooked, but we saw a massive increase in the number of MFN protections that was linked to margin only. MFN, most favored nation pricing protection, should be linked to effective yield, but in Europe we've seen more and more drafting where it's only linked to the margin, which of course means it's very easy for any borrower to avoid that, traditional European loans protection. Do bear in mind that of all the concerning things that we see, this may be one to let go of, given the fact that most European loans will have a 6-month sunset anyway. So, something to bear in mind, but also be aware of the sunset. But let's look at the top left and think about portability. So portability, as I've just said, really was at an all-time high, and it was the biggest and continued theme of this year. In terms of asking for the portability exception, it was very, very rare. I can think off the top of my head of only one deal where it was actually taken out completely. The discussion was really about the conditions of usage. Leverage test as leverage condition tied to the use of a portability exception. More and more we saw that set outside of opening leverage. So the median was 0.5 times, but we saw 0.3 times as well. So that's kind of quite significantly above. Approved buyer list or permitted investor list, that criteria in some deals had fallen away entirely. In other deals, it was just limited. In terms of a fund and its AUM requirement, tended to be lower. Sometimes there wasn't an approved lender list at all. So bearing in mind the buyer criteria has loosened significantly. Of a concern to many of our subscribers was KYC packs and a deemed approval of KYC packs after a very short 5 business day period. If a lender was to ask for more information, that list of requested information needed to be precise and exhaustive. So it's very much onus is on lenders to get back very quickly. Unlimited debt and restricted payments subject to the aforementioned leverage test, and again bearing in mind that those calculations are made on a pro forma basis, so very broad adjustments, and of course certain exclusions, which means leverage, as we've always said, is not necessarily real leverage. And then even blanket permissions for any transactions permitted ahead of, prior to, or in relation to that portability exception being used. So again, the most important thing to take away, if anything, from this webinar is thinking about the conditions of portability and really understanding the amount of flexibility around those. Moving on to the next slide, please. I won't go through all of these because I am aware that we're keeping you over time, but there are a couple of things that I really do want to talk about. The first one is anti-co-op language. So anti-co-op language had a lot of headlines this quarter, and of course, just a reminder, it prohibits lenders from forming groups to negotiate with the borrower without getting the borrower's consent. It's included in the definition of defaulting lender and will have the consequences of being a defaulting lender. During the Q2, we saw it in early bird term sheets. It got flexed out. Second attempt, it made it through the early bird into the marketing term sheet. It got flexed out. Third attempt, it made it through to the draft SFA. Then it finally got flexed out. So we can see the anti-co-op language is getting closer and closer to the finish line of actually clearing the European market. And it's something to really be aware of. Another one, absence of ticking fees. We've seen longer and longer availability periods for all types of transactions, not just M&A, without any reference to any ticking fees at all. And that's something which lenders should be really wary of, because in Europe, and for any US listeners, in Europe it's always going to be on a certain funds basis, so you're on the hook for funding even though you're not getting ticking fees. Bear that in mind. Super majority consent thresholds, we saw them reduce quite a few times, and that's something that we always trying to assist our subscriber base to push back on, but in many deals it was proposed at 2/3. That's very, very low when you think that traditionally the European baseline for majority consent is 2/3. And in some deals, we of course saw that a kind of asserter exception, saying that the borrower could amend the order of priority or subordination, introduce a senior tranche with only 2/3 consent. And that's something that we always flag in any of our research. Buyback provisions, another one I'm quickly going to raise. I don't think they get enough focus, especially in Europe. We've seen more and more buyback provisions allowing for non-pro rata debt exchanges, because the traditional LMA drafting has been amended to allow for bilateral exchanges with no source of funding requirement, and that's certainly something to be wary of. I'm just looking at the questions and I'm going to answer one in a minute, but I will carry on with my thoughts. Another one that just to be wary of is increased insertions of sanctioned finance party language. So, you know, the sanctions provision is a requirement by law, of course it is, and we're seeing it more and more put into documents. It's typically added into the drafting of a defaulting lender. Do be aware, or do at least take a good look at the very wide definition that's being drafted into who is deemed a sanctioned finance party. It's not just a person who is sanctioned. It is any person who is acting on behalf of any other person who is reasonably anticipated to become a sanctioned person. And remember, the consequence of that is no amounts are payable to you if you fall within that definition. So that's, again, a little kind of for the lawyers on the call, thinking about that. And then slightly LME related, but in this very buoyant market, borrower-friendly market, we've seen more and more restrictions on transfer provisions, which are already incredibly restrictive in Europe relative to the US, and more deals clearing with a cap on holdings. So if a potential lender would hold more than 20% of total commitments or 20% of commitments within a single facility, then that again requires borrower consent with its absolute discretion as to whether it's going to give that consent. So next slide, please, Nancy. Right, pushback. So these slides, that each of these bars show how much resistance there is to each clause. It doesn't reflect how commonly these clauses disappeared. It's just about resistance to the clause. I just want to make that very clear. But as you can see, in general syndication, the most common pushback is the two things that you would expect to see: uncapped EBITDA adjustments, so adding a cap. Again, be wary of how good that cap is, and also highest watermark provisions. Now, to be clear again, highest watermark provisions are not new to Europe. We saw them as far back as 2018, but it's only when highest watermark provisions were attempted in the US market that we really saw people start paying attention to them. And we've seen more pushback on it than we had in the past. So there are actually quite a lot of European historic deals like 2019, 2020, 2021, which have highest watermark provisions in them, and then now being refied or A&E'd, and that provision is actually in there, and it's obviously harder to remove. Next slide, please. And this is the amount of pushback we see at early bird. Very much the same theme. The one thing that I would note in Q2 at early bird stage was we saw more pushback on no ratio test for the use of the builder basket to fund investments. And that's something we saw early bird stage being pushed back, but not necessarily at general syndication stage. The next slide. A little bit of good news before we come to the end, and that's the first J.Crew blocker. So there are a few key points, like checklist points, I would say, that our subscribers want us to check in all the deals. There are, of course, and again, this comes from the US, CERTA, Chewy, and J.Crew. J.Crew blocker has been added in the clear majority of deals, and you can see that it's gone up almost every single quarter since Q2 2024. The devil is always in the detail, and it's going to be a question of how effective that blocker is, whether it just limits permitted investments or whether it applies to restricted payments as well. Those kind of questions that you can always come to us to talk about. But we have seen an increase in J.Crew blockers, which is good news. And then the final slide that I just want to touch on is composite scores. So we have North American and European composite scores for all of our loans, and you can see that the winner for Q2 is Skechers. I'm happy to say that it was drafted under New York law and not under English law. But you can see on the European side, there's Alvest, Motel One, Infogroup, a lot of deals out there which have incredibly permissive covenants. I will just take one question, and thank you very much for bearing with us today. Anti-co-op language already made it in USD paper, correct? There is a USD bond where it made it through. I think they call it anti-boycott language. I think that's right, Shoshanna. So will it be just a question of time in Europe? I hope not. I hope that it never gets accepted in Europe. But if we look at the trajectory that we're currently seeing, if the market stays as busy as it is, I can see it slipping through. That would be my final answer on that. And that's it. Thank you very, very much for bearing with us with our technical issues today. If you have any questions for Shoshanna or myself, please do get in touch. The e-learning series, if you want to know more about what we can provide there and the modules that we've done and anything to do with that, again, please get in touch. That's it. Thank you very much. Thank you.